Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is Spotting Winners and Avoiding Losers, Strategies for Effective Company Analysis. My name is Shen Chu. I'm the moderator for this webinar. So in this session, we're going to explore how do we find winners in the stock market and how do we find the signs for troubled companies. So before we begin, as usual, disclaimer, whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risks. Now, allow me to briefly introduce our speaker today. She is the licensed financial planner certified by the Malaysian Securities Commission Financial Planner Representative License and Bank Negara Financial Advisor Representative License. She's a course trainer and public speaker at Financial Planning Association Malaysia and Bursa Malaysia. She has over 25 years of experience in education, where she has accumulated over 50,000 students and conducted over 200 large-scale corporate courses. She's also the best-selling author who has published 6 books on investment and financial planning. And her articles have appeared in financial magazines such as The Personal Money, Money Compass, and Money More. She's none other than Miss Pauline Yong. Pauline, how are you today?
Okay, good. Hi, Shane. Hello, everyone. Good evening.
Yes, good to see you here, and we can't wait to learn from you how do we spot winners and avoid the losers. So I'll just stop sharing
Sure.
my screen and hand over the control to you.
Okay, thank you so much. Okay, let me share my screen. I see that everybody is greeting everybody. Good evening. Hello, Maslan. Some familiar names here also. Li Shi. Hello, how are you? Okay, so let me share my screen. You can see my screen, right? Okay. Hello, Shufang. Okay, so let's share. Now, today's topic is interesting. Think many of you are coming here just to learn how can we spot the winner. And if let's say, hello, Helen, if let's say we are looking at the current investment environment and it is so exciting. Every single day you are looking at the top 10 gainers and they are moving higher and higher. So how do we spot the winners and how can we avoid losers? Okay, so today we are going to look at from the fundamental perspective. Okay, from the fundamental perspective, I'm going to go through some of the basic fundamentals, like looking at the financial statements, and then from the financial statements, we're going to look at some internet sources, so that you can search for annual reports. Not annual reports, the analyst reports. Okay, so analyst report from the internet, and then we look at those a few analyst report, and then I'll tell you what are the things that you need to see, and then what are the criteria. Sometimes we look at very specific criteria. So these are the things that we're going to cover. Okay, so in short, it's about the fair value. The fundamental is about the fair value, and the fair value is looking at the intrinsic value. Okay. Okay, so let's start. So this is what I'm going to do. Okay. And the first thing, the big picture. The big picture I show you here is like a balance sheet. Okay, so this balance sheet, you have assets and liabilities. And a lot of time when we as an investor, when we look at the company, okay, we look at the company from a different perspective. We look at the company, the valuation from the investor's perspective. Whereas if let's say you are the banker, if you're the banker and then when you look at the company, probably you are looking from um, um, the solvency and then the liquidity and all these fundamental of the company. Okay, whereas for investors, we look at the profitability, we look at the return over the equity, and we look at the dividends, whether this company is paying us good dividends or not. So this two perspectives are different. So today we are going to focus on the investor's perspective. And if you look at this diagram, we have assets and the liabilities. Okay. And when you look at here, one is called maximizing the firm value. The other one is maximizing the equity value. Okay. So can anybody tell me um from the investor perspective, okay, so which one you will want to focus? Would you want to focus on maximizing the firm value, or you want to focus on the maximizing the equity value? Which is your focus if you are the investor perspective? Okay, so anybody just type your answer in the chat so that you can see. Okay, so I see many are giving me the right answer. Okay, many are giving me the equity value. Yes, it is the equity value. So where is this equity value? The equity value is here. Okay, and if you're looking at the firm value, it will be this plus this. This plus this is equal to your assets. Okay, so basically it's your assets, but your assets can be represented by debt plus equity. Okay, so or rather we can also look at this whole part here as the firm's value, including the debt. Okay, including the debt as the firm's value. But however, if you are just looking from the investor's point of view, it will be just the equity because we are the shareholders and we form part of this part, shareholders fund. Okay, we form part of this part. So whenever the company make money and then this shareholders fund will enlarge. So whenever the company is making losses, the shareholders fund will come down, shrink. Okay. And it is this part here that determine the book value or the net tangible assets of the company. Sometimes when you're looking at, for example, you're looking at the properties company, like property stocks, okay? So if you notice, right, some of the property stocks that are trading at the moment, right, the price is actually still below the book value. Okay, if you notice that they are still below the book value. Because we have come from the pandemic, okay, where we had a severe recession whereby the properties development were not in the activity. So then slowly we came out of it, and then 2023 started to see more developers are launching the properties, and then leading on to this year, we see that there are more land deals, land transactions, and then more developments. So, but then the share price went up. But despite the share price has gone up, like some even double, some triple. Despite the share price has gone up, right, you can still see that some shares, their price currently is still below the book value. Okay, so which means that is it still undervalued? Okay, so probably they are still undervalued, but you also need to look at the future in cash flow. So in the sense is that when we are looking at the balance sheet, we are actually looking at the historical figure, okay, which is published in the annual report and which is go through the audit and everything. But when what the stock market, the price is reflecting is normally looking at the future. So a lot of time later, when we are looking at the valuation of the company, you will see that they are actually using the forward-looking cash flow, and then they discount back to the present value. So they are actually looking at the future cash flow. Okay, so there are different ways of valuing. So we can say that in summary, let me get my pen. Okay, so in summary, right, the valuation you can look at three perspectives. Okay, number one is the historical. Okay, number two is the current market value, and then number three is the intrinsic value. Okay, which is the future value intrinsic. Now you may think that intrinsic value is the most important, but I will tell you that all of these are important. Okay, all of these are important because all these three, right, form part of your analysis process. When you're analyzing, right, not necessarily you have to keep emphasizing, oh, what's the fair value? What's the fair value? I know when you are in the industry, everybody talk about, oh, give me the fair value. So that's the intrinsic value. Yeah, but besides this fair value, right, you have to also look at the historical, okay, what the company was doing. Okay, so one of the historical, can anybody tell me if you are trying to gauge what is um, the value based on the historical value? What is the indicator or financial ratio or financial um, indicator that you are looking at this month? Anybody? If you are looking at the historical and then you want to know how much is this company worth, let's say this is the ABC company. Okay, you want to see how much is this company worth. Then you are looking at the historical value. So what is that um, indicator, financial indicator? Anybody tell me? Give you a clue. Just now I mentioned the word before. The price to book value. Okay, it's the book value. Okay, no price, just the book value. Okay, net book value. Yeah, correct. Hello, can you hear me? Yes. Can you hear me? Is my voice breaking? Okay.
Actually, we can
Um,
still hear you, just that there were some I don't know how do I put it, but not as
oh,
smooth lah.
okay, I see.
Yeah.
Okay. Okay. Okay, so now I try to see whether it's clearer. Okay, so here we are looking at the book value here. Okay, the book value. The book value is just now I said it's from here, right? The book value. So if you're looking at the company, okay, and the company currently is trading at 1 ringgit, and the book value is 130. Okay, so which means that it is still undervalued. Okay, undervalued in terms of the book value. But maybe the interest value is not there yet, but then the book value wise, it is hard assets, so it's still worth it. Okay, so buying this kind of a stock is still okay. Okay, you don't have to worry because the hard assets are still there. So later on, I will give you more illustration on the intrinsic value. Okay, so let me move on. Financial statement. Okay, financial statement. I'm sure some of you have come across this because maybe some of you are from business student, economics, finance background, so you know. But some people you're probably not familiar with it. Okay, so financial statements are um, the statements whereby the company or even the investors and the bankers and everybody is oh, is it okay? Okay, so yeah, so sometimes you are looking at um the three financial statements. They are the income statements, the balance sheet, and the cash flow statement. Okay, so when it comes to the income statement and the cash flow statement and the balance sheet, right, can anybody tell me which one you think is more important for for valuing your company? Which one is more important? Okay, more answer. Which one you think is more important? Okay. You think cash flow is important? You think income statement is important? Balance sheet is important? Okay. No. Okay. So for investors, when you are doing the valuation, you probably may want to look at the cash flow statement. Okay, because we are using the fair value is using the future cash flow discount back to the present value. So the cash flow is particularly important for valuation. Okay, discounting cash flow method, yeah, correct. Okay, so we have to discount back to the present value. So, but anyway, the three are equally important. So I will show you. So this is a financial statement where you record all the revenue minus all your expenses, and then that will be your net earnings. Okay. And then your balance sheet will be looking at your assets and your liabilities and your equities. So this tell you about the net assets or your net book value. Okay, if you were to go for like a bankruptcy or liquidation, what is the net assets that you have? Okay, where all your assets minus all your liability, that would be your net book value. Then the cash flow, there are three sections here. You have the cash flow from operations, cash flow from investment activities, cash flow from financing activities. Okay, so can anybody tell me which of these operation, investment, financing, which of these is more important? Which of these? And the operation is more important because if let's say your operation, right, is negative, okay? Let's say your operation is negative. And if your operation is negative, right, then you have to rely on these two to give you the money. Okay, let's say you've gone through, let's say you are the tourism, okay, tourism stock, okay, where you are looking at providing um, tourism for the people, okay, and during the pandemic, you cannot operate your business. So then your business is under uh, in the situation whereby you have to stop all the operation. But at the meantime, you have to keep on giving, paying for the expenses, your overhead expenses, you still have to pay. So in the end, your cash flow operation will be negative, okay? And it could be very, very highly, hugely in negative position. So then how can you offset that? How can you mitigate that? So the only way to mitigate that is from these two. Okay. It's from here. Cash flow from investment activity and cash flow from financing activity. So cash flow from investment activity meaning that probably have to sell the plants and equipments. Or if you have land, you have to sell the land. If you have all kinds of assets, you have to sell so that you can get the cash flow. Okay, so whenever you sell, then there is positive coming here. And then here is financing. Financing is either you can borrow money from the loan, which is the banks, or you can raise funds from the shareholders, existing shareholder by issuing rights issues, okay, or private placement. So you can raise funds from your shareholders, or you can borrow money also from the shareholders, or borrow money from the banks. So these are all about money coming in. When you have some form of a fundraising activity, money will come in. So if you have more borrowing, then it will be positive sign here. Okay, so the negative that you had in the operation, right, will be able to covered by the positive from the financing activity as well as the investment activity. Okay, so during the pandemic, you see quite a number of the public listed company, they have to resort to um, rights issues or raise funds, private placements, or even sell their assets. Okay, they have no choice. In order to survive, they have to sell. They have to get the money coming in. So the cash flow is the key. Okay. Okay, next. Cash is king. So which one is healthy? A or B? Which one is healthy? That means you have increased positive from the cash flow, or you have negative from the cash flow from operation, or you have what? Which one is a healthy one? Okay, you're very good. Yes, that's right. Okay, so all of you are correct, 100% correct. Okay, good. So now next we come to the important part, which is the intrinsic value. The intrinsic value is the actual value of a company or an asset based on an underlying perception of its true value, including all aspects of the business in terms of both tangible and intangible factors. Very often when you buy stock, okay, let's say you buy this stock and the share price has gone up 3 times already, triple, from 30 cents to 90 cents. Okay, let's say this stock, particular stock, the share price has gone from 30 cents to 90 cents. Then you are wondering, the price has gone up so much. Where can I sell or shall I hold or where's the target? At what price is the target? So you probably will ask yourself. Some people will say, oh, you just look at the chart and then you see the area wave and then you count the wave. Okay. Now, normally what I would do is that besides looking at the chart, I will look at the fundamental because it is the fundamental that will drive the price higher. Okay, so how do you look at the fundamental? You have to look at the earnings of the company. Okay, say for example, I do not want to recommend stock or whatever. I just illustrate using an example and then for education purpose. Okay, say for example, I share with you this. This SNS aims to tap the country's data center boom from new venture. Okay, you look at this company. I'm sure every day you see this. Okay, I'm sure every day you see this on your screen. Okay, SNS. So if you were to look at this article, right? Sometimes we do not know whether this stock can go higher or not. Here we do not know. So then we need to find out more from this stock. How much do you know about this company? SNS. Can anybody tell me how much you know about this company? What do this company do? Maybe I need to off the camera a bit. Sometimes it's my camera. Okay. How much do you know about this company? Okay. Right. It is too generic. Sell IT. IT is too generic. Specific, specific, more specific. ICT. It have tablets. I don't think it's tablets. Hardware, okay. Hardware, okay. AI, okay, good. AI. And then what else? Hardware styling. No, no, no. I mean, that is small business, okay? That one is a small business. Data center. Okay, how about supplier, right? Supplier for the data center. Okay. Server, AI server, yeah. Okay. Supplier, they are the supplier for the data center. Okay. So they are linked to the data center. Yeah, if you see, this company involved, so it's now expect a meaningful contribution from its newly ventured data center fit out business segment. Okay, so this keyword, fit out business segment. So meaning that you have a data center, I'll supply you with the fit out. I will build nicely for you the connection, the ICT system, okay, the ICT system, and then I will connect you the Wi-Fi, the cable, and everything. So it's like a one shop stop. You engage me, then I'll provide one shop stop for you, and then you get all your network done, okay, in the data center. Comprehensive setup, yeah, that's right. So when you look at here, right, the group believes its financial performance will be lifted by the sale of AI super servers. Okay, so it's concerned with the AI super servers based on the selling price of 1.5 million per unit and a gross profit margin of 15%, which is higher than its existing core business gross profit margin of 5%. So here it gives you some idea. It's 1.5 million per unit. So you do not know how many you need. This one doesn't give you more info. So one typical data center, probably you need a few units. Yeah, imagine how many data centers do we have? The new ones. Okay, so I would think that maybe at least 10 new data centers or maybe 20 new data centers that is about to build. And maybe some are under construction, some haven't even started, and some are newly finishing construction and then looking for people to fit out their data center. So there are still a lot of the data center are still not yet built. Okay, they just recently just have land deal. They just transacted the land. But the building of the data center probably will take another 1 year. And then by the time they will need that will be maybe 1 year later, then you need that. But nevertheless, there are a lot of the data center, quite a number are already just built. Okay, and then they are looking for this kind of a supplier to supply them. So then SNS come in uh very in time. Okay, so they come in time and then they said, here we have 1.5 million per unit. Okay, and then we will supply you, then you have worry free. So when we see this kind of a number as an analyst, so we will try to find out how many units you can sell. Okay, so if you know how many units you can sell, then you will try to calculate what is the potential revenue that you're going to get. So once you calculate that, then you can look at their past earnings, their revenue, and then you try to add on to that past earnings. Okay, so let's say this company before was making about 300 million or 500 million. So then with this, maybe they can add additional 100 million or 20 million. Okay, so you have to calculate. Okay, you have to calculate like that. Okay, so and then you add on, and then when you add on, then only you can see what is the potential, then only you can calculate what is the potential price increase for this company. Okay, so later we will share with you more, and let me go through some of the slides first.
Pauline, your voice is back to normal.
Yeah, because the camera it's a camera that
So
caused
is it the camera distorted your voice just now?
yeah, that's right.
All right, then keep it close then.
Okay, so here we have the formula. So this is like a textbook formula. If you Google, you can find, oh, how do I calculate the intrinsic value? So this formula will also always pop up. And then it's called the discounting cash flow formula. Okay, and this will require a series of cash flow. Unfortunately, I do not have this information. Okay, unfortunately, I do not have this information. So it is based on a series of cash flow and then divided by the discount rate. Okay, the discount rate is based on the WACC. Either you can go by WACC or you can go by the CAPM pricing model. So in this case, they go by the WACC, which is weighted average cost of capital. Okay, now then, okay, how do we estimate the future cash flow, right? That's a very good question. Now, a lot of time we want to get info from the news and articles, and sometimes from the annual reports, if we can. Okay, but if let's say you are the analyst, probably you can pay a visit to visit the company and then try to get some information. Okay, but however, for us as a retail investors, it will be very difficult. Okay, but the normal calculation for the cash flow they are using, you can either use the free cash flow, FCFF. Okay, so this is more technical already, but then just mention now. Okay, I just mentioned FCFF, free cash flow to the firm, and or free cash flow to the equity. Okay, so and this free cash flow to the firm or free cash flow to the equity, right? They have a set of formula, and the set of formula if I'm not mistaken, is equal to the EBIT. Okay, EBIT is earning before interest and taxes, and then plus the depreciation minus your net increase in the net working capital, and then plus one more item. Okay, so you have to use this formula, and then you calculate the free cash flow. And then with this free cash flow, right, you can estimate the next few years free cash flow. Okay, you can estimate the next few year free cash flow, and then you have to make certain assumption about what is the future growth of the company, so that you can try to estimate the free cash flow as accurate as possible. But I know it's it's impossible to be 100% accurate, but then you can try to estimate. Now, there are certain industry, okay, that can estimate this kind of a cash flow more accurately. And there are certain industry that is too cyclical, there's no way, or very difficult, challenging for you to estimate. So can anybody tell me which industry is predictable, and then you can measure and project the cash flow more easily? Okay, which industry? Okay, more answer. I see retail banking, very good. Yes, yes. Finance, yes. Yeah, because the loan growth is like very steady. Okay, the loan growth is always there. Or some consumer stocks. Okay. Construction will be something that you need the data. Okay, you need the figure. And if you do not have the figure, you can't do at all. But the consumer and the banking, even you do not have the figure, right? But then if you have the past cash flow, you can still calculate. Okay. Property, no. Construction, no. Plantation, yes. Okay. And then telco, yes. The toll, yes. So when you are able to see the market itself is very steady, very stable. Okay, and then it doesn't go through like a big up and down. Whereas the property, it goes through a cycle. Okay, property goes through a cycle. Sometimes you have oversupply, then all the developers stop launching. And then when you are looking at, oh, the sentiment is good, then everybody start to launch. Everybody, I would say, every developer start to launch. The oil and gas, it is not very steady is because of the price. The price is too volatile because it's a commodities. Okay, and that goes to the plantation also. The commodities is very fluctuating the price. So you can't, because the cash flow is your revenue. Your revenue is P times Q. You have Q, your Q is steady, but then your P is not steady. So then your cash flow is also not steady. Okay. Um, Sometimes there's a sudden growth of their revenue and prices, and what should we do? Okay, so then you just have to revalue your value. Okay, so the cash flow you just have to change again. When you are doing the cash flow and the intrinsic value, right? You just have to change all this cash flow again. Adjust. Okay, make adjustment. So just like when Garuda and some of the construction company like Suncon, whenever they have a new book order coming in, like for example, recently Suncon secure 1.5 billion of a data center contract. So that's 1.5 billion. Immediately, all the analysts they have to capture that 1.5 additional 1.5 billion into the calculation of cash flow, and then they will adjust the intrinsic value higher to maybe before it was maybe 3 ringgit, now maybe it's 350. You get what I mean? So meaning that you just have to adjust the cash flow according to the new info, and then you add on to it, and then you calculate your intrinsic value based on the new info. Now for tech stocks would be much harder because the technology sectors, the demand and supply is unpredictable. At one time during the pandemic, we are all in shortages of all the supply chain of all the chips in huge shortage. And then suddenly now we are looking at more and more countries uh, spending a lot of subsidies onto the semiconductors industry, and then they are going to build huge factories and then produce a lot of chips. So in the future, we probably may run into oversupply. Okay, already now certain last 2 years we saw some of the semiconductor sectors were oversupplied. Okay, so now we are looking into the next phase whereby it is the AI chips. So if you are supplying the chips and then you are able to move on up to a higher level, then you will continue to get the orders. As long as you can continue to get the orders, your cash flow will continue to increase. The worry is that for tech stocks, your technology still stuck in the old tech. Okay, if let's say you are a tech company, and your technology is still the old technology, and then you do not have new orders, then your cash flow will reduce. So when your cash flow reduce, then your intrinsic value will reduce. Okay, so tech stock is the most difficult to estimate because technology keep changing. So when do I know whether my tech is the latest tech or my tech is outdated? When do I know? Okay, sometimes you never know until somebody suddenly come up with a better alternative. Then suddenly overnight, your technology suddenly become ob obsolete or outdated. Okay. Okay. So let's see. Let me clear here. Let's show you some of the okay, so um, when you are exploring the company, right, you have to look at the revenue. And the most important is the revenue stream because it is the revenue that will give you the intrinsic value or the cash flow. Okay, it is a revenue. And however, this revenue growth very much depends on the competition among the industry. Whether your company can continue to have the revenue growth depends on the competition. Say, for example, the EV industry. Okay, we all know about EV car, right? Everybody seems to want to own an EV car. But however, if you look at the EV industry, right, what do you think about the current EV industry? Is it on the growth stage? I mean, globally, I'm not talking about Malaysia. Is it on the growth stage? The what is the current situation? Okay, oversupply. Yeah, oversupply. Yeah, EV is cooling down. Yes, for sure. Okay, and Tesla is losing. Yeah, and if you notice, Tesla, their battery is still very much I consider the old battery because now everybody is looking at the plug-in hybrid, and then they are using um too much competitor. Yeah, that's right. They are using um different technology in their battery, like sodium or even um with the latest one by the BYD is a plug-in hybrid whereby they have both. You have the ICE, internal combustion engine, as well as the battery. Okay, so you have both. So you can fill in the gas, okay, full, and then you can also charge your battery full. So when you are running and then you are driving and your fuel is running low, then you can switch. Okay, say, okay, I want to switch to battery. So then the car will switch to battery operated. Then it will be powered by the battery. And then halfway the battery is not enough, then you can switch back to the petrol and then you can start to drive. And then while you're driving, the petrol will the battery will self-charge using the petrol inside the car. It will be self-charged. So then in the end, you can run or you can drive as long as 2,000 kilometers range. So that is the latest BYD technology. So if you are looking at the technology of this EV industry, keep on um, improving or upgrading and then keep on changing. So sometimes you never know. You may think that, oh, my car is the best, but suddenly and your competitor come up with a better solution. So then overnight you are facing a drastic situation and where all the analysts will be projecting your cash flow downwards, okay, because of the news like that. So so the industry itself, okay, so not all the industry you can predict accurately, but however, if you are the analyst and then you want to place it, like Warren Buffett, he will always buy the consumer stocks and the banking stocks. If you notice his portfolio are all about consumers and banking. Even the Apple stocks, Apple is also a consumer tech stock because although it is like a technology, right? But then it is used by the consumer. So you can still refer it as a consumer stock because that is the easiest, okay, the most easy way um to estimate. Okay, so you have to compare the historical earnings and then try to look out for consistent growth pattern. And then you will have to also go look at the industry comparison, compare the revenue across the industry, look at the benchmark, identify the market leaders and the laggards. Okay, a lot of time when you are buying into stock. Okay, so we all know that currently the teams are running the properties, constructions, utilities. Okay, so these are the three teams that are running. So if you are looking at these three teams, right, property, construction, and utilities, right, uh, it is quite obvious to see who are the leaders. So let me ask you, construction, name me one leader or name me two leaders. Construction stocks, name me two leaders. Okay, good. And sunlight, yes. Okay. Now, let's talk about utilities. Utilities, name me two leaders. Utilities, name me two leaders. Okay, good. YTL Power and IGM also. IGM is also, but it's not top two lah. IGM is not top two. I said top two only because I only want to buy top two. You don't have so many money, and I mean you don't have so much of a capital, right? You cannot buy too many stocks, so you focus on the top two. The Naga and YTL Power, correct. Properties, okay. Properties, there will be a bit of a challenge there because properties, there are so many properties and they are all unique in their own way. Okay, so for properties, I will look for 5 property stocks. And anyway, they are very cheap, like less than 1 ringgit. Okay, okay, maybe a few months ago they are less than 1 ringgit, but now maybe they are more than 1 ringgit. But the thing is that they are, in terms of pricing, they are very cheap. So you can easily own five of them. Ecoworld, yes. UEMS, yes. SP Satya, okay. Sam Rabi Property, IY Property, yes. Any more? IY, UEMS, Sam Rabi, Ecoworld, and SP Satya. Okay, so these are the top. Okay, Massing also. Okay, so these are the top property stocks. So when you know who are the properties top leaders, right? Why do you still want to go for the laggards? Okay, you will go for the laggards under one condition. For me, lah, okay, I normally will only go for the laggards if I already own the leaders. Okay, and then I have some extra money and then I want to go for some speculative play. Then I'll go for the laggards. Okay, otherwise I will just stick to my leaders. As simple as that. Okay, and because normally the leaders will go higher first, 1 round or 2 rounds first. Then only the laggards will start to go in. Okay. Yeah, matrix are the smaller one lah. Okay, I'm looking at the bigger one. All these are smaller ones, smaller ones. So we go for the leaders are normally the huge market cap, large market cap. Okay, and they are favored by fund manager, the funds. Okay. So that's how you look at it. Okay, sometimes it's about common sense. Very, very much about common sense when you look at the fundamental analysis. Okay, it's not that difficult. Although you may think the numbers are difficult, but however, how much percent you want to allocate for the numbers? I will allocate 50% for numbers and 50% for uh, the outlook, the business outlook. Okay, so the qualitative factor account for 50%. And the construction stocks info is quite controlled in terms of the info they release. Quite control. Well, yeah. In the sense, of course, all the public listed company they want to announce when whatever the info that they want to give. Okay, and unless you have insiders information, um, very much most of the time we do not have insiders information. Then we will have to rely on the public info. So if you have to rely on the public info, given that lack of transparency, then the wise choice for you to do is to go for the top two leaders. Go for the leaders because you know that once you are buying into the leaders, um, you 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 don't have to worry. Okay, they will get the orders for you. I mean, the book orders will come in. Okay, okay. So all this webinar will be recorded and then be released by the Malaysia channel, YouTube channel, as well as the live chat YouTube channel. Okay, so you can always go back. I mean, maybe wait for one more day, then you can review back. Okay, for the YouTube channel. Okay, now next important. Okay, I want to show you how you can get the analyst report. Okay, so for the analyst report, we have to identify, okay, first the industry. Okay, so normally in the analyst report, they will tell you, oh, what does this industry do? What does this company do? And then what is the strength and the weaknesses of this company? So all these will be addressed under the analyst report. So here I have a few here. Let's take a look. Okay, normally I will go to Pusa Marketplace. Under the Pusa Marketplace, you can log in and then you can search for the stock name. So once you search for the stock name, then you scroll down. You will see there is a. Wait, let me go back first. Let's say you search for a stock name, okay? Then you come to this page and then you come to this research. Okay, you click research and then you will see all this analyst report. So let's say the latest one is by MIDF, June 4th. And there's also another one by Maybank, April 7th. So I prefer the June 4th, okay? And then you can click either, you can click download. Okay, so once you click download, then you can see the TND. Okay, so here I have prepared for you a few analyst report. Okay, and then they are from different industry. So that I want you to see what's the the important stuff on this. So the first one I want to introduce to you, it's not recommendation. All these are for education purpose. Okay, it's not recommendation. Now the first one is KBJ hospital. Okay, if you notice, the hospital bill are getting more and more expensive. So which means that in terms of the revenue, the hospitals should be getting higher revenue. Okay, and one way to look at the revenue is from here. Let's say KPJ. So this one is a I3 investor. Okay, you click the KPJ, and then you click the financial, and then quarter. KPJ financial quarter, and you scroll down, you see all these earnings here. So if you look at this KPJ, you will see the earnings before the pandemic, 2014, 2015, and then all the way to during the pandemic, and then now we are here 2024. Okay, so when you look at these, right, the important is that you want to see the revenue has increased. So before you are looking at 800 per quarter, this one is per quarter about 800 million. And during the pandemic, it dipped down to less than 700 million. And now it become 900 million. Okay, since last year, started to touch the 900 million. And this one is increasing. So maybe in the future, right, it will reach 1B. 1/4 or 1B it will reach. So meaning this is a high growth industry. Okay, and you see their earnings are growing like this, year on year, quarter on quarter. So this is a high growth. Okay, so let's go back here and read. And then you look at under the analyst report, normally they will recommend whether you need to buy, you need to hold, or you need to sell. Okay, so in this case, they recommend a buy, and their target price is 2.54. And so this is the main thing. So when you look at the analyst report, the first thing you have to see this recommendation and then this target price. So that's why they put it on the top here. So this is the main thing that you need to see. So after you see this, then you read on. Okay, because when you read on, then you know that, oh, this KBJ has how many hospital beds in the whole of Malaysia. And then and the revenue per bed is how much. Okay, sometimes they will say something like that, but I'm not sure whether this one they will say something like that. And then so you get all this information. Here it says that inpatient added 3%, okay, with an average revenue per inpatient standing at 7,498. So this is a good estimation. So you know that one hospitalized patient on average will pay a average bill of 7,500 ringgit. Okay, and then you can start to estimate one month how many patient, how many hospital beds. So let's say the last time I read about it, they have about 3,000 hospital bed. Okay, so 3,000 hospital bed, and then you multiply the 7,500 ringgit per bed, and then you try to estimate, okay, for um 1 month, and then for 1 year, and then things like that. So then you can get the revenue. So once you get the revenue, then you can um, see the potential, because the share price go higher if you can prove that the revenue is increasing straight away. Okay, so just like recently a few of the land deal happened. um, Microsoft bought from Equities, and then UMS sold the land to another buyer. Okay, the buyer was not known, so we do not know who is the buyer, but the value was 145 million, and the Equities value was 500 million. And then there are a few transactions. It's all about a few hundred million. So straight away, people will ring in their mind, oh, a few hundred million, all this added onto the revenue. Then you see what is the extent, how much you try to estimate, oh, how would that convert into the price? And then you see how would that give you the price increase. Okay. And as you read on, you can see that their recommendation of 2.54 is see here, okay, the last line here. We maintain a buy price of target price of 2.54, but they didn't say this one is based on um what. Okay, sometimes they will say that, oh, this price is based on the uh, financial year 2024 25 times PE ratio. Okay, sometimes they will say something like that, but this one they didn't. Okay, so yes, all these are publicly available. So the next one I want to show you is a consumer stock. And this one is Padini. Padini is a very stable. Well, you may think that, oh, during the pandemic, they have lost some sales, right? But now, after the pandemic, their sales should be picking up. But of course, this industry is quite uh, competitive because it's a retail industry. Different research house will give different. Yes, correct. Because they analyze differently. Okay, do you know that the formula that I shared with you just now, the free cash flow over the discounting cash flow method, right? That one is just one of the valuation method. There are so many valuation method. So maybe this research analyst is using the free cash flow method, but the other analyst, he's using a dividend discount method, and then another analyst is using another method. So they have so many methods. So obviously you will see different target price. But what you can do is that you open up different one, and then you try to get an average price, get average the, and then so that you somehow you see that, oh, average the target price is about this. And then when you are investing, you can assume that the price will move towards the target. Okay, it will move towards the target. Normally, okay, it should move towards the target. Which research house is more accurate? I think all of them are good. Okay, because sometimes certain analysts may be good in a certain sector. Another research house, maybe they are good in another sector. So I would say that all of them are good. Okay, so this is a PR thing. Okay, then so here the Pardini, right? Then they will also give a fair value of 4.3. And let's see their recommendation. Maintain a buy 4.3. Okay. 4.3 based on the PER of 14.5 times, 3-year forward consumer discretionary mean of PER pegged to Pardini's financial year 2025 forecasted results. Okay, forecasted earning per share of 29.6 cents per share. So this 29.6 cents is not the historical earning, it's the forecasted earning per share. So then they are based on this PE ratio, and they give this fair value. Okay, so this is one example. And then another example is TNB. TNB maintain a neutral and then revised target price of 11.52. Okay, so revise, sometimes when you see revise, meaning that they have added some revenue and then they want to upgrade the price or whatever. Okay, sometimes it could be added cash flow. Sometimes the cash flow can be reducing. Maybe they lost a major customer. Let's say if you lose a major customer, then you will revise your cash flow and then revise your target price as well. What are the methods you mentioned? Okay, discounting cash flow method, dividend discount method, and then maybe you also have your own like innovation, because sometimes you look at you can combine together, or maybe I want to add free cash flow and then I want to add one more item. And so that sometimes it's difficult to say which it's difficult to say pinpoint exactly what are the method, because it can be variant meaning that I change a little bit this formula, I change a little bit and then become my formula. Okay. Mm. The target price is year end, yeah, that's right. The normally it's 1 year. Every IB or research house has their own agenda. Yeah. Okay, so here is a neutral. Our target price is raised to 11.52 with a weighted average cost of capital of 8.5. This is their discount rate, 8.5. And then their PE ratio is 13.9 times. Okay, so this one is based on the financial year 2025. Okay. Well, no, it's not like that, okay? Because what I notice is that whenever the analysts, right, they have a certain call, for example, RHB recommend a buy call on one of the stock. And you can see that immediately, right, the share price will go up, okay? Because people will react to the news. So they are many people, many investors out there, they are actually reading the analyst report carefully. Okay, so which means that um, you will be surprised. There are so many of people out there, they are reading the analyst report. So naturally, the target price that they mentioned, right? Somehow the share price will move towards that. Okay. So another example is this YTL Power. And then the maintained buy revised target price is 6 ringgit and 35. So then you can see that they have certain interesting information here, which attract my attention. NVIDIA is here. It has a medium-term target because they have the AI, NVIDIA AI data center. Now, what is a AI data center? They are the traditional data center whereby one typical data center will require 15 megawatt watts of the power. Okay. And then this traditional mega data center, right? They are using the normal computer and the whatever. But with the NVIDIA, recently they released a new product and it's called the AI and it's supplying for the AI data center. So what they can do is actually to bring down the megawatts. So the traditional data center will require 15 megawatt to power. But with the AI data center, you only require 4 megawatts only. 4. You greatly reduce your power by so many times. So, and YTL Power is supplying them with the AI data center, and they are using the H100 chips and the GB200. This GB200 is their latest technology. It's called the Blackwell. Okay, it's their latest technology where it only gives 4 megawatts only. It can run the power more faster, okay, more efficient. But anyway, what interested me is that in the long term, because this YTL Power, they have in Kulai, they have 664 hectares of land. It's able to accommodate up to 500 megawatt of the data center capacity. So this is very huge. Okay, so meaning that they are, because one data center only 15 megawatt. So this one is like 500 megawatts. So you're going to power so many. Okay, 500 divided by 15 is how much? 30 data center there. You can power 30 data center there. So which means that and this is not yet, you're just building the thing. You don't and you haven't even built it, you just got the land and you are building. And when they are going to supply, it will be much later, maybe 1 or 2 years later. So which means that for this particular stock, right, it's not going to be like a short-term hold because you see they are going to supply uh, in this thing which is maybe 1 or 2 years later because now they are still under construction. So meaning that the real benefit you can only see it maybe 1 or 2 years later. So which means that and then once you supply right the data center, you don't stop the data center will be in operation for 10 years, 20 years. So the power that you supply will be 10 years, 20 years. So it will be a long term. Okay, it's a long term thing. So, so which means that if you are buying into this kind of a utility stocks, whether it is CNB or YTL Power, right, it's more for the longer term. I think in my opinion, okay, not no recommendation, not recommendation, but just my thought only because I'm reading this. Okay. When the research report will be released, okay, every 3 months, because every 3 months they will release their quarterly earnings report. And then when they're releasing the quarterly earnings report, then the earning per share or the earnings will be revised. So then the analysts will have to feed in this information back into their Excel spreadsheet or whatever spreadsheet that they're using. And then they will start to calculate the fair value. Okay, so that so every time when the company you are in charge, let's say you are the analyst, okay? If let's say you in charge this company, then you in charge of a few companies, you have to take note of their quarterly earnings release date. Because once you got the earnings, the latest earning, you have to recalculate your fair value. Okay, so and then you have to come up with a report. And this thing come every 3 months. For one company, it's every 3 months. If you have a few company, it will have a lot of work to do. Okay, so analyst job is tough, challenging. Then this one is another one is Gamuda. Maintain the buy, and then the revised price is 6.8. Okay, and then you will say that their target price. Sometimes I want to see how do they value the target price. So we are upgrading our target price from 598 to 683 as we pack the group's financial year 2025 earning per share of 42.7 cents to a PR of 16 times. Okay, and which is about one standard deviation above its 6-year historical mean. So meaning that they are packing based on the PE financial year 2025. of 16 times. And this price is also one standard deviation above the 6-year historical mean. 6 years is the last 6 years, okay? What is the mean? And then based on the mean, you plus one standard deviation. And the standard deviation can be calculated by the Excel worksheet normally, okay? Which is the volatility, where you can use the traditional calculation where you look at the price. And then from the price, from the Excel worksheet, you can actually call in the Excel formula. You just highlight those price and then you compute standard deviation. And then you highlight the price and then it will compute the standard deviation for you. Okay, so all this can be calculated. Okay, it's not difficult. The difficult part is the valuation. Okay, the revenue. That is the difficult part. Okay, so then you can see, have a sense of the different industry. They you look at different things. Okay, for this, like Gamuda, you look at the book order. The book order um referring to the projects that they are having. Okay, so if I'm not mistaken, they have about 26B of a book order. Okay, I'm not sure whether this one's state here or not. They have about 26B of the book order, outstanding book order, and then it's still counting. Here, 25B. Now set at 25B of the book order. Okay, so this book order that matters. So if let's say they have new projects, then they will add on to the new book order. Okay, this is the construction. And the power will be the capacity, the power capacity, and then the power capacity. And then this one is consumer is more to the market share. And then this one, hospital is the hospital bed. How many hospital bed you have, the whole wide Malaysia, and then how much you are charging on average per hospital bed. Okay, then you calculate. So these are the things, okay, that you need to see. Then, and all these things will convert into money, revenue, and then revenue will convert into the share price. Okay, Shi Wei asked, based on the report, Ames Group is the data center arm of Time.com. I thought Time had sold off by Ames to an American company. Okay, so this one really I do not have the information, so I cannot answer your question. Okay. Yeah, I'm not sure whether they have sold the company or not. Okay, but anyway, let's go back to my slides. Okay, so assessing the competitive advantage. So this competitive advantage is something that is not so much of a number, but more like a common sense. Okay, you from your observation. So the most common way of analyzing is using the SWOT analysis. Okay, which is looking at the strengths, the weakness, the opportunities, and threats. Okay, so the strength and the weakness refer to the company itself. What are your internal strength and weakness? Opportunities and threats refer to the external factors. Sometimes your internal, you are very good, strong management, but externally, the factors are very harsh on you. Say, for example, Padini. Okay, Padini is a very sound, conservative management company. Okay, so their management is very good. Okay, so that is their strength. But however, during the pandemic, the threats is the external factor. They we do not have a there's a lockdown and then people cannot go shopping and then so that affect their retail business. So you may have a strong management, but however your environment can be harsh on you. So then this will also affect your share price. Okay, so that means you cannot always go for the best management. Okay, oh that's the best management, I go for it. But look at the industry. Is the industry uh, favorable for your company? Okay, so if it's not favorable, then there's no point holding this stock. No point. Because no matter how well you do, your environment is not doing you good. And sometimes the management may be not so good, but it is the team. The team is running. Everybody is buying the property and construction. But your company management is not good. Okay, but still your share price will go higher and higher. So it's very difficult to say which one is important. It's you have to combine all these factors together. So in the end, I would think that the external factors like the team will overrule. Okay, which means that as long as the teams are running, everybody is talking about it. Every day you see the news, people will be interested in the sector, and then people will keep buying that sector. Okay, yeah. So let's see. This one. What do you think? Is this a good stock? Opportunities affect the sentiment. Yeah. Yes. Opportunities or even threat. You have good news, bad news. Affect. Okay. Can you guess what stock is this? Which stock? What stock is this? You see, you have 5B of a revenue. What stock is this? 5B per quarter. Anybody guess? Well, bank. No. No. Bank is 1B only. No, consumer cannot be. Tech also cannot. No. Tech, the most is like a few 100 million only. No, no, not control. TNB, no, it's YTL Power. Okay, it's YTL Power. So this is YTL Power. You see their revenue is super. Okay, and then um from the before the 2021, during the pandemic, it was about this, and suddenly now it is like double up already. Each quarter is double up. Okay, so um they are doing very well. Okay, okay. No, it's not Massing, it's YTL Power. YTL Power. Yeah. Okay, how do we analyze the financial strength? So normally we will look at some of the financial ratio. The most important financial ratio, I would think is the PE ratio. Okay, so that's the most important. And then if let's say you want to know the internal strength, whether this company, the cash flow is healthy, you probably may want to look at the liquidity ratio. Okay, the liquidity ratio. Yeah, YTL Power, because they're expanding. They need a lot of capex. Okay, they're expanding. So if you think YTL Power is dividend too low, then you buy the higher dividend utility stock. There are other choices. Okay. Now, um, the most important, the liquidity, right? I would think is this current ratio, CA over CL, which is over 20 years ago I held, turned blue in my face. Yeah, yeah, yeah. I also bought it last time at I remember last time below 1 ringgit or something. Long time ago. Okay. Yeah. But anyway, if you look at this CA over CL, it's actually looking at the current assets over your current liability. Current assets over your current liability. So which means that your current assets are those assets are less than 1 year. That you can easily convert into cash in less than 1 year. Current liability means that you have to pay the obligation in less than 1 year. So as long as current assets is greater than current liability, you are in a good shape. Okay. Um, Normally I will look into that. And then sometimes I do look into debt and equity, but not all the time because we are in a low interest rate environment. So the debt is not really a problem. So the debt over equity, and then the interest rate coverage ratio, whereby you are looking at whether the company has the financial means to cover your interest. Okay, every month you have to pay the interest. So whether you have the ability to cover that. Then the profitability, I would think is important. Okay, particularly the net profit margin. Okay, normally I'll look at the net profit margin, and then for the valuation, the PE ratio. Okay, some people just now you mentioned price to book value, right? Price to book value is also interesting. Okay, so if you look at this, um, nothing. Okay, you see 1.77. Okay. And then if you look at their price over net tangible, your net asset per share is 1.42. Okay, so now it's higher already. Before they were below. Okay, so now over higher already. Okay, the PE ratio, whether it's too high or good question. Okay, naive. Okay. Okay. I definitely have to mention about the PE ratio in this class. So when you look at the PE ratio, right, different industry, okay, different industry, they have different average PE ratio. Say, for example, if you say, oh, the banking is about how much? Maybe 12 to 15. Okay, it's not high, it's about 12 to 15. And then you say, oh, technology is how much? Technology is about uh 30, 30 to 40. Okay, some even 80. Okay, so that's technology PE. But the industry is about 30 lah. Okay, 30 or 35. That's technology. The average industry PE ratio. Then when it comes to the construction and the property, the construction is lower. Okay, like Gamuda is maybe 11 or 12. YTL Power is also 12. TNB is about 15. Okay, um, so you have to look at the industry PE. How do you get the industry PE? Is by looking at the stocks under the same industry. So for example, you gather all the stocks, all the property stocks together, all together, and then you look at their PE ratio, and then you divide it by the number. So you get an average. And then that's how you got the average. Okay, so then you want to be compatible to the average. Yeah, we need to manually calculate because I try to find the industry, right? This Busan marketplace they do have, but then however, there are pros and cons lah. Okay, so for example, you download this report under uh, the Busan marketplace. Okay, let's say you go for YTL, then you download this. Okay, so now once you download, right, you scroll down and then you come to the middle part here. So these are the utility company. Some are not so pure utility, like this solar vest is not a utility. Well, they do provide energy lah. Okay, yeah. So some are this one are still okay lah. Power and water. Okay. So then this will get an industry PE. The average here, is 23.6. Then YTL power is 11.9. TNB, TNB is 32 already. Okay, 32. Okay. So others are still below 20. Yeah. Okay, so then at least you can see the average. But sometimes they are not like exclusive. So if you were to look at the industry is a bit of everything. Okay, sometimes you see other sector also come into the industry. Okay, but this one is quite good. Okay, construction also quite good. Certain industry they provide quite detailed. I mean, include all the relevant stocks inside, and then the industry average will be more relevant. Okay, then uh, let's say we look at just now I was talking about this one. Okay, and then let's say we look at another stock. If we have this. Okay, if you look at the UMS, right, the share price is currently 1.22. And then the net asset per share is 1.35. Okay, so meaning although this stock has gone up like 2 times or 3 times, I mean 2 or 3 times, right? But you see their net book value, the book value is still, the price is still below the net book value. Okay, so meaning that, and this one has a lot of land. They have the largest land in the Iskandar area. And the land valuation in the past, maybe about 1 ringgit, 2 ringgit per square feet. Now the recent transaction by the Equities is 75 ringgit, right? I think it's about 75 ringgit or 70 ringgit per square feet. That the one that sold to Microsoft. Okay, when the previously Equities bought the land for maybe 12 ringgit. Okay, so you can see the kind of gain from the land and the valuation also. The valuation of the land may be the older valuation, so may not truly reflected their net book value. And so these are all potential gains now. Okay. Okay. So next, how do we look at the warning sign, the red flags? Okay. So going to be quickly looking at it. So here we have one example. Here is London Biscuit Berhad. I'm not sure how many of you still remember this stock, London Biscuit Berhad. So this London Biscuit Berhad was delisted, but before they delist, actually they had run into some problems. So in the end, the auditor um, raised the red flag. Okay, once the auditor raised the red flag, then the whole thing bring to the public. Okay. Yeah, collapse. Yeah, that's right. So, but before they collapse, right, there were signs. Okay, so what are the signs? So they have a persistent decline in the profit margin over several years. And the gross profit margin fell, okay, from 18% to 10% within 5 years. And their net profit margin, right, consistently below the industry average. So meaning they are not performing already. Okay. And they have a very high debt level from 0.8 to 2.5, and heavy reliance on short-term debt to finance the operations, and inability to service the debt, resulting in the frequent refinancing. So that means their their books are not good, and their fundamentals are not good. Okay, so these are all the warning signs. So in the end, the auditor raised it up, and then the share price collapsed. Okay. But still can this ideas why? Well, as long as your net, because there are certain criteria before you be classified under the PN17. So one of the criteria is that your shareholders fund, right, you cannot go negative. So for example, the AirAsia, why did AirAsia went to PN17? And that was because their shareholders fund has gone to negative. Their losses has widened. When you keep having losses, remember just now I said that when you have profit, your shareholders fund will expand, increase. But when you have losses, then your shareholders fund will contract and then will decline. So when you have so much of a losses until your shareholders fund become negative, then you'll be classified under the PN17. And then when with the PN17, you will be delisted. Okay, so that is the path. Okay. So then also continue, they have frequent changes in the key management positions and high inventory levels and all this. Okay, particularly this one. Okay, high in the inventory because it shows that your stock cannot be sold. Okay, and then of course the final concern is the auditor. Okay, so all these are the red flag. But sometimes it could be too slow. Notice because when the time they have the red flag, right? Already the gap down already. So then what do you do? Normally when I see gap down, right, I will quickly sell already. I don't care. I just see the gap down, then I just sell. Because sometimes I don't know what's the news. The news may not come out, but the gap down come up first. So when you see the gap down, you haven't found out the news, just go first, exit first. Then only you try to find out. Okay. So now I want to answer some of your questions here. Okay.
Thanks, Pauline, for doing this session. So due to interest of time, we will just take maybe 2 to 3 questions, okay? So I see the first question by Vincent is intrinsic value the same as enterprise value?
No, it's not. intrinsic value is the discounting cash flow method, whereas the enterprise value is the inverse of the P ratio. Okay, when the P ratio, you use your price over your earnings, right? So the enterprise value will be looking at the earnings and then divided by the market cap. Okay, so it's different. Okay,
All right.
then next
Thanks,
question.
Pauline. The next question is, how accurate are these analyst recommendation?
I wouldn't say 100% accurate because these are all judgment like your different perspectives. Just like for me, I also look at things differently from you guys. So you just have to gather a few of them, and then you read a few analyst report of the same company that cover the same company, and then you try to um make some average calculation, okay, like a average target price. Yeah.
All right.
Next question.
So let's do one last question by Faiz. When it comes to valuation, right, PE, right, which do we use? Do we rely on trailing PE ratio or do we rely on forward
Forward
PE
PE.
ratio?
I will rely on the forward PE because the forward PE will be looking at the intrinsic value, which is the fair value. Has to be the forward PE. If you look at the historical, that means you are just looking historically. You are not looking at the future cash flow.
All right. Thanks so much, Pauline, for addressing the question. So before we end the session, so let me just take over a little, the screen control. All right, just give me a minute. Yeah. Okay.
Okay, Albert. I hope everybody can benefit from this webinar.
Yeah, I think I see a lot of good comments here. So before we conclude the session, I will just give a little shout out to My Bursa, which is a platform that Bursa Malaysia developed for retail investors. If you go to bursamalaysia.com, you can move your cursor here and click on explore My Bursa. So if you click on this My Bursa, it will take you to a My Bursa platform whereby it has give you access to Bursa Marketplace, give you access to Bursa Academy, and also have a support tab to help to help and support the retail investors. So on My Bursa, there are a lot of tools at the moment, but of course, in phase 2 and phase 3, there will be more tools being rolled out. So if existingly we have screener and heat map already, you can go to the heat map to get an idea, a visual idea of what is happening in the stock market today, and you can go to screener, to help you to filter and reach the stocks that you want that meet your criteria. Okay, so there are fundamental filters, there are financial filters, and there are also technical filters. All right, so you just key in the value here, and then you click screen, right? Click submit, right? Then stocks that meet your technical criteria, fundamental criteria, or financial criteria will be shown in this screen. So these are the new tools that Bursa Malaysia developed for investors for free that you can use. All right. So before I conclude, you haven't checked out Bursa Academy, you can scan the QR code to go to Bursa Academy, which is a comprehensive one-stop e-learning platform that aims to provide you with a continuous and holistic learning journey. So for our next webinar, which is happening tomorrow morning, so it is titled 如何运用突破策略交易潜力股 In other words, tomorrow morning, we will examine how do we use breakout strategies to trade these momentum stocks. So if you know Mandarin and you want to learn how do we use breakout strategies to profit from momentum stocks, register for the session that I've given you in the chat box, right? So you may register at the link that I've just given you in the chat box. So it's happening tomorrow morning, 10 o'clock to 11:30. All right. So if you haven't opened a stock trading account and you want to open a new stock trading account, you can scan the QR code or click the link that I gave you in the chat box to fill up your interest. All right. So with that, I want to thank all of you here for staying tuned until the end of this webinar, and thank you so much to Pauline for sharing with us, your nugget wisdom in how do we do effective company analysis, how do we spot winners, and how do we avoid the losers. All right. So take care, everybody, and hope to see you in our next webinar. Bye bye.
Okay, bye-bye. Thank you. Thank you.